With us, someone who is well watched across the globe and especially in the United States. We are being joined by Ethan Harris, who is the Global Economics Research Head at Bank of America Merrill Lynch. Thank you very much, Ethan Harris, for staying up for us and joining us this morning here in India. Pleasure to have you with us. Well, for starters, let's take the entire global economy. Do you think global economy is going to be better off in 2017 or worse off?
So in our calculation of global GDP, typical growth rate is about 3 to 3.5%, and that's kind of the area we've been stuck in over the last 6 years or so. But there are reasons to expect a little bit better growth in the next 2 years, something more in the 3.5 to 4% range. I think the main story here is fiscal stimulus coming in the United States and a number of other countries, and that should kind of bump us a little bit above this kind of slow, steady recovery we've been in for the last 6 years.
Okay, if that's the guess on the global economy, what is the position in the United States itself? Are you penciling in much better growth? You're expecting the economy to fire away because of fiscal stimulus?
Well, I think that the U.S. will start off in a moderate trend at the beginning of the year as people digest the new policies of the president. But by the second half of the year, with tax cuts coming in, with some spending, including on infrastructure, we would expect growth to pick up to about 2.5%. And we think that continues into 2018. So it will be a period of better growth, but there are limits to how fast the U.S. can grow. We're already pretty much at full employment right now, so if the Trump administration pushes too hard on the accelerator, then the Fed will be forced to hit the brakes hard. So I don't think we should be expecting a boom in the United States. I think just a little bit better growth.
Okay, so better growth coming in from the United States, perhaps growth rates of 2.5%. But Ethan, the fear is that this U.S. growth, the incremental growth, could come at the expense of other countries like China, Mexico, as well as some of the other emerging markets. What do you have to say to that?
Well, the danger in the next year is protectionism. If the new administration does impose tariffs or other kinds of restraints on trade, then U.S. growth would come at the expense of other countries. We expect only small actions in those regards. So we think that the main effect of the new administration will be stronger U.S. demand, a stronger currency, and so at least some of the U.S. strength should flow overseas and help support global growth. So really the question is, do we get the growth positive story mainly, which is a fiscal policy and a deregulation story in the United States, or do we get some kind of very aggressive trade protectionism? We're looking for more of the good growth story coming from deregulation and fiscal policy.
Let's talk a bit about the dollar then. Already at 103 plus, do you see a lot of strength in the dollar in 2017?
I think the dollar's big move has happened. I think the market is anticipating fiscal stimulus in the United States, and so we've had a fairly sharp move since the election. The dollar overall up more than 4% on average. Most of the moves already happened. But I do believe that as we see implementation of fiscal easing in the United States, the dollar will continue to creep higher. And what that does, of course, is it tends to constrain some of the strength of the U.S. economy, but does help the U.S.'s trading partners. So I do think the big moves already happened as the markets anticipate the policy changes that are coming.
Now, that will influence commodities, won't it, Ethan? What's your call on commodities? Are you expecting, because you're expecting modest growth in the U.S., would you say that commodities uptick will continue, crude, metals?
Yeah, so our view is that commodities do have a slight upward bias going forward, not a dramatic improvement, but tendency to move higher. We'll probably be seeing a little bit better global growth. We've also seen some of the excess supply come out of the markets with the OPEC agreement and with a big pullback in U.S. oil production. So if we look broadly across commodities, they seem to have moved into a better balance. And so as long as the growth does pick up, we should see a modest pickup in commodities along with that GDP recovery.
Okay, what does all this mean for the US Fed? If commodities are rising and there is going to be a bit of inflation, will they go through with the threatened 3 rate hikes?
Yeah, so I don't think the Fed will do 3 rate hikes next year. I think they'll probably do more like 1 or 2, and the number of hikes they do will depend really on whether we have a smooth sailing for the economy. What we've seen in recent years is that the Fed forecasts multiple hikes each year, but then when the economy hits speed bumps or when we have difficulties in financial markets, the Fed postpones. So I would only expect 3 hikes in 2017 if it's smooth sailing, if we don't get any bumpiness along the road. I do believe as we go further forward into 2018 and 2019, the Fed will accelerate, because by that point, we think they'll be achieving their 2% inflation target, and we think that they will feel much more confident about the recovery once the fiscal policy is implemented and is adding to support to growth. So over time, some acceleration in Fed rate hikes seems quite likely to us.
So what does this do to the movement of smart money? In the last 2 months, we have seen money move away from the emerging market assets into the developed economy assets, especially the United States. Is that a trend that will continue in 2017 as well?
Again, I think one of the key things looking forward is what's the policy mix in the United States? If we get a situation where you have a lot of protectionist measures and the U.S. is growing at the expense of other countries, and this is going to be a bad environment for emerging markets. But if we have a more healthy kind of fiscal policy and deregulation-driven growth, well, there's be some pressure in emerging markets because there's going to be some ongoing move higher in interest rates in the United States. It's something that probably the emerging markets can live with and do reasonably well with. So really we're going to learn a lot in the first quarter. We're going to find out a lot about how campaign rhetoric is translated into actual policy changes. And so at this stage, we're cautiously optimistic on a kind of a positive growth outcome, which is positive for emerging markets as well as the U.S.
Well, that's good to hear, which brings us to our favorite emerging market, India. Ethan, how do you think India will come out of this currency change that we are going through? Will 2017 see faster economic growth compared to 2016 in India?
So we're looking for moderate growth by Indian standards, with the new version of GDP growing at between 6 and 7%. In 2017. We think the demonetization program, the black money campaign, will slow growth, certainly in the end of this year, and so it does give a kind of a weak start to the new year. But India should be supported by the general global backdrop and by other central bank policies. So again, kind of moderate growth by Indian standards in 2017.
Okay, well, 6 to 7, not a very pleasant number, but okay. Thank you very much, Ethan Harris, for your analysis of how the world might pan out. Pleasure having you with us this